In this video, we'll talk about a pattern in smart money concepts called an order block. We'll look at what this pattern includes, whether it makes sense in terms of real market mechanics and physical processes, and whether it can be used in trading. Let's try to figure it out. If we look at Google's definition of an order block, we find the following explanations. First, it's a price zone on the chart where large market participants place big buy or sell orders, most likely large limit orders located in a specific area. It also reflects significant activity and order accumulation. In other words, zones where a large number of orders are concentrated show high trading activity and order buildup. Another definition again describes it as an area where major participants, banks or large hedge funds, place buy or sell orders, levels where price may react because of high trading volume. And this is important, high trading volume. These areas must have high volume. According to this definition, it's a zone where big money accumulated a position and left pending limit orders to hold the price in case of a return or reversal, a candle that absorbed the orders of large participants. From a pattern perspective, the idea is as follows. We have a downward movement. A final bearish candle forms, after which the market reverses, according to smart money. Liquidity accumulates above extremes in the form of stop orders. When price moves down, stop orders are triggered, and retail traders also sell, expecting further decline. At this moment, big players place limit orders, absorb all liquidity, and price then moves upward. In the opposite case, with rising highs, buy-stop orders accumulate above them. Large players place limit sell orders at those levels to accumulate a short position. This forms a zone where the large participant built a position, followed by a downward movement. The pattern shows that price forms a zone from which it later moves upward, and another one from which it moves downward. Now that we've covered the definitions, let's look at some examples. Before looking at examples, let's briefly return to market mechanics. Let's enable the tape and the order book. At every moment, there are limit buy and sell orders, those who want to buy or sell at the best price, and market orders from participants who need immediate execution. When market orders come in, they are matched with limit orders, and a certain volume is traded. The numbers show how many contracts were executed at each level. If we look at the delta, we can see whether buys or sells dominated at each price level. Green delta indicates more buys, red indicates more sells. Delta is the difference between market buys and market sells. Therefore, when an order block forms, there must be big volume. Based on the definitions, participants should be accumulating a position at that moment, which should later lead to a market reversal. Now let's look at the examples from the earlier patterns and compare them with actual cluster and volume data to see what really happened. Here we marked two order blocks. Let's check the volume. When we show the volume display, we see that at this spot there was no significant activity or large traded volume, just ordinary trading similar to other bars. In another area, we see some larger clusters and there is some movement. But the most important area is this region. Unlike the two order block patterns above, here we see a huge amount of traded volume compared to other clusters and bars. The lower panel also shows increased volume per bar. In the clusters, we see large prints. If we look at the delta in this zone, we see dominant market buying. On the candle wicks, there is a dominance of buys. So in reality, the whole area is the actual order block, all of this, because if we apply a volume profile over this entire section, from here to here, we see that most of the volume was traded here. This is the true value area. This is where price balanced. Most volume was here, not in the small area marked by the smart money order block. This means the small region is not significant from a liquidity standpoint. The main position was accumulated here. Delta shows massive market buying that didn't result in continuation upward and instead moved down. If we look at the cumulative delta, we see continuous rising buying pressure even while price didn't move up. This means market buys accumulated and hit limit orders placed here, either real limit orders, iceberg orders, or algorithmic execution. The volume was transacted here, and this liquidity fueled the downward movement, not the liquidity grab at the top of the small pattern. Next example, an order block forms. Looking at volume, there is nothing notable here. But in this larger area, we see many large clusters. This shows that this is where the limit orders were placed and where market sells were hitting them. The volume profile also shows that approximately 70% of all accumulated volume was in this area. So it wasn't the small volume in the smart money pattern that moved the price. It was this large accumulation zone. Next, two order blocks formed according to smart money. Looking at volumes, just slightly higher than usual. But here we see much more volume. This is where the real movement originated. If we apply the profile, we see that the accumulation took place here. The first pattern didn't work at all, and even the second one wasn't the catalyst. Neither the supposed liquidity grab nor the order block according to the pattern provided fuel for the move. Again, an order block is marked. But looking at volume, there is nothing special here. Other areas have much higher volume and more importance. If we strictly follow the definition, there is no block of limit orders here that could cause a liquidity grab. This liquidity above the high was not the reason for the move. Another example. There is some liquidity zone and an order block pattern that partially worked. But volume is nothing unusual here. In fact, a much larger volume cluster is located elsewhere. 5,000 contracts is not enough to move the market in this context. The main volume was traded in this larger region. This is where the participant accumulated a position. The small manipulative spike is not a true order block. The real liquidity was in the broad accumulation zone. Using real volume tools, actual traded volume, delta, bid-ask data, and other cluster volume indicators that rely on real volume rather than price-based formulas, we get a clearer picture of what actually happens. We can see where large players were active and where true order blocks, real clusters of orders, formed. With only a candlestick chart, we essentially have no information. We can't see the actual activity, the effort of buyers or sellers, or how much money was put into specific price zones. Trading becomes blind pattern matching, disconnected from the underlying physical processes and market mechanics. As a bonus, if we add the HeatMap indicator, it shows the history of the order book, past limit orders. On the right side of the chart, we see current limit orders via level 2 histogram, and HeatMap shows their history and changes over time. We can see that even if the book shows large limit orders, it doesn't mean they will move the market. Often they are not executed and serve as manipulation. Let's look at examples. In this example, a limit order of 98 contracts was sitting for a long time and was likely executed. We see delta confirming market sells hitting it, after which price moved. But we cannot know whether iceberg orders or other hidden liquidity were used. Another example. At a high, large limit orders were displayed, but they were not executed. The clusters show only small volume, 19 contracts, 25 contracts, while the limit orders appeared as 605 and 659 contracts. This means they were spoofed, placed, but never intended to be filled. They acted as manipulation. Another case. An enormous order appears but is removed. Again, not real volume, an unexecuted order block. Other times the orders are real. For example, 157 contracts displayed, 340 traded with positive delta, likely executed. Another example, 800 contracts displayed but only 249 traded, so the liquidity was removed as price approached. Another case, 500 contracts sat for 10 minutes. We then see large volume executed and positive delta. Most likely those limit buys were filled. So with HeatMap, we can see real order clusters, real order blocks. But whether they will be executed and how price will react, no one knows. Real cluster information lets us see where real order concentrations existed, where large volume was transacted, how buyers and sellers were distributed. If large selling effort was applied here, large negative delta, and price still moved upward right after, these sellers are trapped and price reverses. Another example. Price rose, then returned to a limit order zone shown by the heat map, yellow. It executed, 500 traded, and price rose again. This small area served as a real order block and support. But true liquidity, driving larger movements, forms over time across broader price ranges. Real accumulation zones, not small manipulative spikes, are the true source of fuel for price movement. Hopefully, this video helped clarify the picture. Observe real physical processes and market mechanics behind price movement, and move away from pattern-only trading toward understanding real information available now, without relying on patterns that contain minimal actual information. It's better to see the real mechanisms instead of guessing.